Okay, so good morning all. So in our first class, we said we are looking at basically three things: cash flows, discount rates, and time. And I told us in our second class that it's not every time. In fact, typically, your examiner will not give you the cash flows. You will determine the cash flow. And going further, we said that among the cash flows will be among the elements that will determine the net cash flow is tax. And we said tax, there are two elements to tax. One is the tax you pay on the profit you make from your operations. The second is tax savings you get, or tax shield. You can see it as tax savings or tax shield or tax benefits you derive via capital allowance, which we call tax allowable what? Depreciation. So that's it. That will lead to what? Tax savings. And we said the tax savings is equal to the tax rate multiplied by the tax allowable what? Depreciation. And we said to get the tax allowable depreciation, we are either applying the straight line method or the reducing balance method. Is that okay? Okay, so for the straight line method, it's the same annually. For the reducing balance method, you have different amounts annually, but it will gradually reduce depending on the reducing balance ratio or the percentage. Is that clear? And we said that under tax, while considering tax, especially tax savings, we may have to deal with balancing charge or balancing allowance, which essentially are elements of balancing adjustments. And we say balancing charge arises when you make profits on disposal, and that profit on disposal will arise if your sales proceed is higher than your tax written downwards value. And we said balancing allowance will be like a relief from the government to you because you incurred loss while disposing or selling a qualifying capital what? Asset. And this arises when your sales proceed is less than tax written downwards value, so you made a loss. Is that okay? Now, typically, you don't see in net cash flows, in determining the net cash flows, the schedule, you don't typically see the balancing charge or balancing allowance. Most times, in most texts, they put them together. So the balancing allowance is put together with the tax elements in the last year. For instance, the last one we did, I think we got for year 4, we got 15,000 something as tax for year 4 using reducing balance method. All right, 15,000 something, and our balancing allowance was 32,000 something. Is that okay? In some texts, what you will see is that last year you see tax savings, both the 15 and that 32 lumped together. Are you getting me? Personally, I prefer having them separately shown. Is that okay? But for you to actually get your net cash flow, which is the cash flow you apply the discount factor on before you arrive at your present value, this is what you typically will have. You have, so we want to get a format for your net cash flow. This NCF is what?
Net cash flow.
Man, don't do it like that. Like I told you, net is something minus something. So net cash flow in this instance is the difference between all your cash inflows minus all your cash outflows. That is what you discount. So, format for net cash flow. We have first revenue. Let's say you have different years. 0 must be it. 1, 2, 3. Assuming that year 3 is the last year. Are we there? So first you have revenue. Revenue will not normally flow in year 1, in year 0. Year 0 is when you are building the factory. You've not started operation. Year 1 is when you start operation. You started selling. 2, 3. Are you getting me? So revenue will not affect year 0. You see it in year 1, year 2, year 3. Each year you operate, revenue will come, except the examiner tells you otherwise. Are you getting me? Don't tell the examiner that normally, if the examiner says year 1, there won't be revenue. You've started, but year 1, there's no revenue. You don't tell the examiner that normally there should be revenue in year 1, so you know more than him. He's telling you that there's no what? Revenue, and you will take it. If he says year 3, there's no revenue, you will take it like that. Are you getting me? So the next is what? Variable cost. Variable cost is an expense, so it is going out less. Are we there? Yes. Now I've told you guys before, in finance or accounting generally, if you put less, don't put brackets. If you put brackets, don't put less. This is an indication of what? Subtraction itself. So don't be repetitive about it. Less minus no. Just variable cost, this, straight up. Next is fixed costs. For fixed costs, let me tell you, you only consider incremental fixed costs as being relevant. What do you consider as being relevant? Incremental fixed costs. If I spent 50,000 building my barbering salon, I've spent it, it's already fixed cost. In the future, it is not relevant to decision making. It's like it's sunk. You have spent it, whether one customer comes or not, it's not relevant to decision making. Are you getting me? So I told you, every relevant cash flow must be what? 1. 2, what? So if, for instance, Dangote PLC, their fixed cost is 15 billion naira. If they set up another factory somewhere, their fixed cost will increase by, let's say, 5 billion. That 5 billion is what? Relevant. But the 50 billion is not relevant. If they've set up their factory 50 billion, but inside their factory they want to open another division, and that division will not cost them anything, it will still be in that old 50 billion what factory. It is not what? Relevant, because setting up that new division or department will not lead to an increase in their fixed what? Cost. Are you getting me? So this is essentially your operations. What do I mean? You made profit, you made sales, you incur. As I am now, I will get revenue from you guys. Am I right? I've already incurred fixed costs. The rent I paid, whether one person come or nobody comes, so the rent I paid from the beginning is fixed as far as this year is concerned. Are you getting me? So it is fixed. Then variable cost. Each diet I come, I will incur certain costs that are related, because people are coming. I must come. There must be transportation expenses. I must pay people that work for me. I must buy marker and all of these things. These are what? Variable. Are you getting me? These are variable costs. So revenue minus variable minus fixed. At the end of the year, what will determine my profit is what I paid as fixed and the variable what? Cost I incur. So that will determine my profit. Here I call it net sales. I call it what? Net sales. So we have net sales. So these are born out of your operations. I'm assuming that it is positive. These are born out of your what? Operations. You don't do business. Here don't end. You don't make profit. Government will do it in tax. So this will be taxed. The percentage will be here. If it's 25%, 25% on the profit. If it's 15%, 15% on the profit. If it's 2%, 2% on the profit. So tax will be charged by the sovereign authority. So here operations ended. Your business operations ended. The next we are now considering will be your capital parts. So you bought an asset, a machinery, a plant, building. So that is initial outlay. That is in year 0. That is in year what? 0. Now, there are things with which you know year 0. If you are taking ICANN exam, the examiner will not tell you anything like year 0. Are you getting me? But there are certain words you will get from the question that will make you know that this is year 0. If you hear the word today is what? Year 0. Write it down. So the organization is expected to spend 20 million naira on plant and machinery today. That today they are telling you is what? Year 0. If you hear the word immediately means what? Year 0. If you hear the word now, you read and you get the word now. Now means what? Year 0. If you see the word currently means what? Year 0. These are the 4 denominators that define year 0. Year 0 can actually be 1 year, can be 2 years, it can be 5 years. That is typically year 0 is the time span between when the organization starts putting itself together till when it concludes putting itself together. The years Dangote spent building its refinery will be referred to as what? Year 0. Whether it's 10 or 5, we just ideally see them as 1 year, but practically it's not 1 year. Are you getting me? Practically several years, but we call it what? Year 0. Okay. So
if the capacity of Dangote is 50,000 and he wants to expand to 100,000.
That is incremental. It is incremental in as much as it will lead to what? Increase in the fixed cost. Remember when we talked about fixed cost under PM, I told you that fixed cost can be what? Straight. But there will get to a time that fixed cost can never be straight. You will see it go up and another straight. Right now it's even expanding. So it means that its own kind of cash flow will be an unconventional cash flow. What did I say about unconventional cash flow or non-conventional cash flow? I said it here when I was talking about the difference in comparison between IRR and NPV. I told you something about unconventional cash flow. That an unconventional cash flow will give multiple IRRs. I said it. Unconventional cash flow will lead to IRRs, multiple IRRs. So you calculate IRR, you get this. Another person calculates, you get this, another different thing. Because unconventional cash flows are cash flows where the inflows and outflows occur multiple times. So normally, conventionally, year 0 is for what? Outflow. The other years are for what? Inflow. But when the cash flow is unconventional, you see year 0 maybe outflow, year 1 inflow, year 2 inflow, year 3 outflow, like that. You see them, then you know that it's what? Dangote, a practical example of unconventional cash flow. He set up this business, he started last year. This year he said it's expanding to 1.4 million barrels per. So right now they've expanded to 700,000 barrels per day right now. That's what they've expanded to. Refining capacity. So there's still what? Outflow. In year 1, inflow is coming, but outflow is also occurring massively. So that's an unconventional one. So let's go. Initial outlay conventionally will occur in what year? Year 0. It's an outflow. Buy machinery, buy plants, building, motor vehicle. So you see nothing. You see scrap value or residual value. You see scrap value or residual value. This will be what? Outflow or inflow? Inflow. What year? Most times at the end. But the examiner, even if he tells you that it occurs year this, don't tell him that you know more than him. It will be an inflow. Next is tax savings, which we have taken care of. tax savings will occur in the year tax is paid. Are you getting me? So it can be in what? Arrears. It can be in actual year basis, but let's assume that's done on actual year basis. And the cash flow is conventional. So you have this, it is a plus, not a minus. Then we have working capital. We'll explain working capital. In fact, we'll talk about it. Today we'll talk about inflation and working capital and maybe take one question. Working capital will typically occur from year 0, year 1, look at it to year 2, then why this one is not in bracket, no be mistake, because working capital will be recovered. We'll explain it. Will be what? Recovered. Don't worry about it, we'll explain. If there is any other one that the question defines, for instance, the question can tell you rent. Rent can be fixed. So if there is rent, rent is an operational thing. It's not a capital related thing. Rent is an operational thing. Rent is something that will make you determine profit. That's what I'm saying. And profit is more like here. So rent should fall here. Are you getting me? Are you getting me? The examiner can even tell you, oh, the company bought plants and bought building. Plants, tax allowable depreciation will be applied to plants, but it will not be applied to building. Don't tell him that both of them will have what? Tax allowable depreciation. Compute your tax savings on the one which he told you that capital or tax allowable depreciation is applicable on. Are you getting me? You can spend 50 million on plants and building. They will now tell you building 1 million, 10 million, then plants 40 billion. Then somewhere along they will tell you that this one plant is what is plant is what capital allowance is granted on, not that of what? Building. You cannot use the entire 50 million. Use the capital allowance to compute the tax savings on the elements which they told you it is applicable. So let's go. So this will give you a net cash flow. Net cash flow. Typically this is like this. This should be like this. Typically. Then when you get your net cash flow, this is the cash flow now that you discount. You apply a discount factor depending on what the examiner told you. You apply a discount factor 1.00, 0.909, 0.826, 0.751. So discounting will give you your what? Present values. Because this cash flow is negative, this will be negative. Then you get your NPV, which is equal to present value of cash inflows minus present value of cash outflows. Where is the present value of cash inflows? All of these ones, present value of cash inflows, because these were our cash inflows. You discount to get the present value of cash inflows. You add them up. Where is your cash outflow? This is your cash outflow. So this is your present value of cash outflow. It gives you this. This will give you your what? NPV. Is that understood? I took time to explain this because when we begin to do it, I want you to know each and every. Now, each and every element has a different way of computation. For instance, we now know how to do this and this from what we have done. From what we have done so far, we know how to get your tax and what? Tax savings. Inflation can affect it. We'll learn how inflation can affect this one now. Then we know how to get your working capital. When we know these ones, we'll take a question. Exam-based question. Are we there? So let's go. If you are taking anything down, take it down. Uh-huh. To take down is not mandatory. This one no be. I plug my internet. It's what? Good one, sir. This will be better, in as much as it's not. Look at it. When you do your hand like this, what do you mean? It should face the board. When you say people at the board. As I know, it's recorded class. So the people wherever they are might not see the board. Kirikeni. Because it's a bit dark. Not it's a bit dark. This is actually dark. See, I was thinking we turn on this other light for Okay, don't worry. This is really they're as bright as. It's still not bright, right? Then it will reflect. Me. Okay, maybe I should just put the light.